Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Akila binti Zahari, and today I would like to present my individual assignment regarding capital structure. First, let me explain what is capital structure. Actually, capital structure refers to the specific ratio of debt to equity that it used to fund all aspects of operations and expansion. Debt typically takes the form of loans or bond issuance, whereas equity might be represented by common stock, preferred stock, or retained earnings. From a business point of view, equity is a more expensive long-term source of funding with more financial flexibility. When money is needed, a company with financial flexibility can raise it on fair conditions. On the other hand, equity is the owner's claim to the company's future profits. In contrast, debt is a less expensive, limited to maturity source of capital that requires periodic refinancing at an undetermined cost and legally binds an organization to fulfill pledged cash outflow on a predetermined schedule. However, one of the two primary ways a business can raise funds on the financial markets is through debt. Debt also enables a corporation or organization to keep ownership. The term optimal capital structure refers to the most effective or appropriate ratio of debt to equity that lowers the company's cost of capital, notably its weighted average cost of capital, which is WACC, while raising its market value, which is shareholder wealth. The market value of the company will increase as the cost of capital decreases. WACC, cost of debt, and cost of equity have an impact on a company's optimal capital structure. The company must consider the signals that its financing decision send to the market in order to determine its optimal capital structure. A company with promising future may want to obtain cash through debt rather than equity in order to prevent dilution and from sending the market any unfavorable signals. Debt signaling is the practice of a firm making announcements that are generally viewed as good news. Potential equity investors examine a company's debt to equity ratio to determine how hazardous it is. In order to determine whether a firm is using an unusually high level of debt in its capital structure, they also analyze the amount of leverage other companies in the same industry are using, assuming that these businesses are operating with an optimal capital structure. There are some factors affect capital structure and capital structure decision. Firstly, a company's capacity to raise capital is influenced by its size and scope. Long-term borrowing can be challenging for small business due to the size of their operations. Creditors are reluctant to lend to them. Even if they do receive these loans, they must agree to stringent repayment terms and high interest rates. Secondly, a company with a high business risk would like to have little debt because its earnings are more unstable. A company with minimal business risk can have a bigger debt component in its capital structure because there is less chance of predicted earnings fluctuating. The higher percentage of debt raises the company's financial risk in terms of fixed charge and timely principal repayment. Next, tax consideration. The high cost of equity funds is a result of the Income Tax Act's rule that prevent deduction from dividends paid on equity, share capital, and preference share capital. Debt interest is deductible from income, which lowers the company's tax obligations. Lastly is timing. The state of the economy, boom or recession, will have an impact on when the capital structure decision is made. It would be easier for the company to raise stock during boom times, but during a recession, equity investors won't be as interested in participating. The company must then rely on debt financing. When a business or individual is in financial distress, it means that they are unable to satisfy their financial responsibilities because they are not able to create enough revenue or money. This is typically caused by high fixed expenditure, a high percentage of illiquid assets, or revenue sources that are sensitive to economic downturns. Individuals may experience financial distress due to the bad spending habits, excessive debt loads, lawsuits, or job loss. Companies having a higher risk of going through financial distress will borrow less money than companies at a lower risk. Additionally, the firm's assets play a major role in determining the consequences of financial distress. For instance, a company with a majority of tangible assets that can be sold without suffering a significant loss in value will be enticed to take on additional debt rather than business that rely on intangible assets because these assets cannot really be sold. A trade-off must be made when deciding on a company's capital structure between the tax benefits of debt and the expenses of financial distress. Financial cost distress is the cost associated with a company's inability to pay its liabilities and debts due to a financial distress condition. Companies take on debt with a short-term or long-term return to fund their operations. However, experts in finance and related fields have long thought that a company's value increased when it switched from stock to debt. As the debt level increased, the value of the expected tax shield from debt also increased. However, the value lost due to the expected financial distress cost. The marginal cost of more expected financial distress cost eventually just balance out the marginal gain of interest tax shield. The optimal level of debt in the company's capital structure is limited. The conflict of interest that develops between management and shareholders is referred to as agency cost of equity. An agency cost of equity has developed when management takes actions that shareholders see as not being in the company's best interest and as not increasing the value of their shares. For instance, management can think that merging with another company would be the greatest move for the company, while shareholders would recognize that this would not help the company develop and that the money spent on the merger would be better spent on dividends and other investment. The agency cost of equity would be the expenses incurred to prevent the merger, such as lobbying. According to the pecking order theory, a business should choose to finance itself initially internal through retained earnings. If this source of funding is not accessible, a business should then borrow money to support itself. Lastly, a business should only fund itself as a last option by issuing new equity if the funds cannot be raised through the debt as well. This pecking order is crucial since it informs the general public of how the business is doing. The pecking order theory has a number of key benefits, including the ability to help determine how information asymmetry influence financing costs. Then it assists business in selecting the best method for raising capital to finance companies' strategies such as a new project. On the other hand, it demonstrates how desperate the company managers are to keep a tight grip on the business. However, there are drawbacks with the pecking order theory as well. Firstly, the theory only considers a small subset of variables when assessing how they affect the cost of borrowing. Next, it does not give a precise approximation of how the flow of information affects financing costs. The signaling theory is a result of information gaps between shareholders and company management. Managers will first issue debt and then equity if they think their companies are undervalued. In contrast, management will issue equity first if they think their company is overvalued. The theoretical presumption that rising debt levels are a sign that management are optimistic about future profits may very well have an impact on leverage. Managers sign debt contracts as a promise to pay future interest. Bankruptcy may result from failure to pay debt. This sends a message to the market that the company is confident it will generate enough cash flow to pay off its debt. The remaining claimants to a company's cash flow are its shareholders. This is because dividends come second in importance to interest payment that have been committed as obligation. Thus, share price react to news about the financial structure more strongly than bond price. I think that's all from me. Thank you and Assalamualaikum warahmatullahi wabarakatuh.